welcome to Business Television India. I'm Fatima Mahdi and you are watching Financial Planner. Joining me on the show today is Feroze Azeez, Deputy CEO at Anand Rathi Private Wealth Management. Feroze, thank you for this conversation right here on Business Television India. Let's start by talking about this whole specter of market pessimism that seems to have set in. There seems to be this sort of sentiment of uncertainty about the future outlook of the domestic economy as well as some of the global factors that are playing up. How should investors be looking at all of this news?
So I think very importantly, Fatima, like you rightly pointed out, there's enough pessimism, or that's a perception of a negative environment, which is actually at its peak over the last couple of years. You've not seen such pessimism. So point one, you're absolutely right. The pessimism is at the peak. Point two is you have to see what information to you as a specific individual is important, and you have to cull out that piece of information which helps you take decisions, because just information doesn't help you take decisions. Like BTVI says, save, invest and prosper. So there is an action of investing or disinvesting which needs to be culled out of every optimism or pessimism. Point three I'm making is you have to categorize yourself as a trader, an economist, or maybe an investor. If you're an investor, be rest assured that in an investing life of 10, 20, 30 years, you're going to have situations like these at least 30 times or 20 times. So how you react during those periods of time will actually dictate the fate of your wealth at the time of retirement or at the fag end of your lives. So reaction will decide where you are. So if you're a trader, you need to get a grip on the direction of the market. If you're an investor, you have to get the trend correctly. And I think the trend of the Indian economy has not changed. The direction of the Indian economy may have changed for a quarter, 2 quarters, a year, but the direction of the Indian economy is definitely right up there. So that's how I would look at it. And I've heard a couple of experts saying that we are into a recessionary kind of a phase. Yeah, all said and done, you from 1997, your economy has gone up 5.5 times. That's what mattered to an investor back then, and that's what would matter to on a prospective basis to an investor who is today.
Feroze, it's wonderful that you make that distinction between investor, trader and economist, and also what you really are saying about the overall trend. I want you to flesh out a little bit more about this entire commentary about India going through a recession versus a short-term slowdown, and really distinguish between the two when it comes to the situations that are currently prevailing.
See, I think if you see the attributes of economies which have gone into recession are very different. A recession in a demographics like India is going to be something which is very tough to induce. Even if there are policymakers trying their best to induce recessions, it's going to be tough in the demographics of a country like this. Point two, which I would like to make, is when you look at the GDP in the global context. The real growth for this year globally is about 3%. You are at 6.8%. In any stretch of imagination, you can't call this a recession. And recessions are long periods of degrowth or no growth in the economy. If you look at it, we were this year beaten by France and Britain to come to the 7th spot. But I think you are in the top 7 any which way, and you were the top 5th in FY18. Now in FY19 you are in the 7th place. But I think your $2.7 trillion economy is bound to, if not like spelled out in the budget, happen in 4-5 years, but it can happen in 7 years. But at least there's a target. And third is you have a large economy is propelled by government spending. And government spending is propelled by tax collection, and tax collection in India has a huge scope of improvement in terms of compliance on the direct taxes. I think compliance on direct taxes can completely change the balance sheet of the government and in turn the spending of the government in the economy, and then whenever the government spends on the lowest strata or the lower end of the pyramid, and the multiplier effect on government spending is humongous to the economy. So I don't see a recession with a barge pole, but you can't call India getting into a recession over the next 2, 3, 4 years clearly.
Sure, fair points there, and relatively, I mean, I think the kind of proportion of negative sentiment is a little excessive. Now, just staying with this entire conversation, Feroze, tell us a little bit about this whole feeling about the higher taxation in India, as well as this entire business of what what FPIs are up to. Explain that to us, and also just contextualize what exactly has happened there, and whether this outflow that we have witnessed is something to worry about.
I think Fatima again very rightly said, contextualize. I think most people don't contextualize and read each and every piece of information without the broader context. So point one, of course, higher taxation could be to different categories of people. One could be a foreign portfolio investor, which is what FPI is an abbreviation to. And you have the salaried class, you have the middle class, you have the super rich. To my mind, I think the government has been generous on all counts. If you look at an Indian context, a middle class Indian can get away paying zero tax if he or she uses all the provisions up to 13-14 lakhs of salary per year, and that's in Indian context a reasonably large salary for a per capita income wherever it is. So point one. On the super rich, if you compare it with the top 10 economies, I don't think there has been penalty significantly more than the economies. In the US, you have the state tax as well. That adds up to whatever the taxation super rich are going to be paying in India from this financial year after the budget happened. Then coming to FPIs, which is what the market sentiment is all about, and that's what I think Fatima you would be interested in knowing and wanting me to contextualize. I think 60% of the FPIs have taken the corporate route, for whom there was no change in surcharge. Point two is there is 40% who have used the trust vehicle like they use globally. Most of these portfolio investors use a trust vehicle to invest and participate in equity. That's what they've done, and that has a higher surcharge. And of course there was some degree of non-committal hearing out kind of a session which is expected with the finance minister, and if that gets addressed, it's okay. But if you see the calendar year, we've got 75,000 crores from this community, and we have a 15,000 crores exit from this community. So if you contextualize it, you're still 60,000 crore positive. That's one way to contextualize it. The second way to contextualize it is a 15,000 crores getting out of our market, which is nothing but the 2-month SIP amount which mutual fund domestic investors bring back. If you see this in context, we have had far worse phases where FIIs have sold out or FPIs have sold out and are 10 times more than the SIP book of the Indian mutual fund industry. Today it's just 2 months. Mutual fund systematic investment plan actually collect about 8,000 odd crores. So context could be on the basis of what is the domestic inflow, and context could be with respect to how much has come in this year and how much went out, which is not abnormally stark. So they're still net positive for the year.
All right, so once again, check the numbers, in fact, contextualize those figures and understand the overall picture. Feroze, I just want to come back once again to the economy and the conversations that seem to be dominating the airwaves. How should investors look at the kind of slowdown that is being reported in terms of demand in India? And I guess this ties into the larger conversation we've already had about the economy, but this whole talk about the slowdown, how we should actually perhaps look at that going forward as investors. What is your take on that?
See, firstly, if anybody is pessimistic, the first question I think all of us should ask him or her is to say, how long are you pessimistic for? This most important question is not being asked. Today I've heard over the last 10 days a lot of corporate CEOs being negative. But how long are they negative for? Are they negative on India for 10 years? Is there anybody who says that? Because an investor's time frame is 10 years or if not more, or 5 years. So there isn't anybody who's pessimistic. They have to give a time frame. If you give an opinion on the market or the economy, that needs to be followed with the time frame of your opinion, which is the missing link. That's why the investor community is confused and the trader community is missing out relevant information because the time frames of your pessimism. Even if I am pessimistic for a month, I would just say I'm pessimistic. So very importantly, if you're an investor and a viewer, pessimism has to be read with a time frame, or optimism has to be read with a time frame. So I would, as a wealth advisor or an investor myself, I would make sure that there's a time to my opinion. which generally people get away without making a time frame to their opinion. That's point one. That's why you can cut the clutter. Point two, as an investor, I would still devise a strategy which focuses on risks. So focus on risk, measure risk. Okay, so when we recommend portfolios, and my portfolio in particular, which I can speak of, is something which has a risk measure of 7. I will explain what that is. That is a standard deviation of 7. Nifty's risk measure for the last 3 years is 13. So if you have not measured this for your portfolio, you have not begun risk management. So in times where you worried about risk, you will have to measure risk, manage it. So 13 is the Nifty standard deviation. If your portfolios have standard deviations greater than 13, you certainly have all the right to be worried and pessimistic. If you have a portfolio or a construct of your entire money put together is less than 6, 7, 8, then you have nothing to worry. Corrections are good news for people who have a lower risk measurable, because when the markets fall, you don't fall as much. So that's why risk has to now change from an English expression to a numerical expression. That's when you will be able to navigate the high tide or a rough weather. If you don't have measurements done so far, then there is something which is largely missing in your business of managing money. So exhibit more professional management, and then you will not have to be worried about the short term 1, 2, 3 months, 6 months, even a year. You will not have to worry, provided you have a strategy to back which has both risk and return measured. That's what I would give as a very, very important tip. Of course, it's easier said than done. Your advisor should be asked this question if you have one, or you have to do some more homework on your money.
Feroze, just a little bit about, you've sort of specified the numericals when it comes to standard deviation, as well as, I guess, taking risk as an opportunity. But how often should investors be reviewing their portfolios given the current market scenario?
See, of course, your vigilance has to be very high, okay, because all the three asset classes which are important to you and me, one which is equity, real estate, two aggressive asset classes, two conservative asset classes, which is gold and debt, at least three financial, equity and debt are going through their own share of pain. So your vigilance has to be high. So how frequently do you need to revisit your portfolio? First is you have to understand what you own. Most HNIs or even retail investors, when you meet, they don't know what they own. For example, if you asked a person, if you hold 5 debt funds, how many bonds do you have in those 5 debt funds? People don't even know what they own. So there was one person I met, he had 5 debt funds. I asked him, how many bonds do you own in these 5 debt funds? He says, I don't know. If that's the kind of thing you're able to relate to, first you have to understand what you own, then you have to keep checking what you own to see whether there are changes needed. So I get most of my friends and family and my clients follow the same 8 debt funds and 8 equity funds which I follow, so that I see that every day, and that's the highest frequency of vigilance you could get. So that's what I do as a strategy. Second is, now to answer your pointed question, Fatima, after going around a little, the pointed question, how frequently should you review in times like these? Every quarter you should review and not get worried. Fear and greed can definitely give you the most irrational decisions. So instead of being worried, look at data. There is enough evidence in the past that there have been instances of immense pessimism. For example, the times of demonetization. There was immense pessimism, but the subsequent 1-year return of Nifty was 25%. So you might not want to go with the pessimism and act in the direction of redeeming your money. Maybe putting some more money could be a action. So please don't get emotions into your decision making. It's going to be tough for you to take this piece of advice, because mind and the heart both need to be taken care of when it comes to money, and don't let the heart overplay and supersede the rationality which the mind can bring into decision making.
Very, very well put as usual, Feroze. Just to go back to this whole concept of fear and greed a little bit. Another sentiment that investors have been concerned about is lack of liquidity in the system. What do you have to say about that, specifically in context to, I guess, investment activity and concerns around that as well?
Correct. I will definitely be concerned about liquidity if I'm just going to retire in the next 3 months and I want all my money getting into debt. See, if you're looking at liquidity, will this tight liquidity situation continue for the next 2 years? I doubt that. Why? Because again, everything has a time limit. Most of us, of course, I know that there is a liquidity crisis. You know there is a liquidity crisis. Most pessimists know there is a liquidity crisis. But how long will it stay there is what you need to do homework. I personally think your 10-year G-Secs have sharply fallen. Government paper has now come down after the budget from 7 odd to 6.3 or whatever it is today. Second is that SBI, which is the largest bank, has reduced fixed deposit rates. People will follow. Of course, NBFCs don't have the money. But I was speaking to several CEOs of the NBFCs and they say we issued a bond and we collected 300 crores, 400 crores. Sometimes the perception of liquid.
All right, so the numbers are flashing on your screen and we are talking about the SBI first quarter here. And if you look